On All About Stocks this week, strong performance by the market. Both the Nifty and the Sensex ended the week up 3%. We'll tell you what your investment strategy should be. Our investment advisor, Paras Edelweiss, has made a profit of 19% on his portfolio. We're going to tell you how he did it. And tire stocks are in focus this week as they rally hard on falling rubber prices. What should you be doing in this space? Welcome to All About Stocks. You're watching ET Now. Thank you for joining us. This is a show for long-term retail investors, and we've been giving you advice on investing in stocks for nearly 3 years now. This week's show will prove to you that careful stock picking, management of your portfolio and a long-term view does in fact pay off. We'll tell you how Paras Edelweiss' portfolio has managed to make a profit of nearly 20% in 1 year. And he'll give you tips on how you can make that happen in your own portfolio. Remember, if you have any questions about your stocks, you can write to us on the email ID that's at the bottom of your screen. Let's take a quick look at how the markets did this week. The December series got off to a decent start thanks to some short covering. The Sensex went up nearly 250 points on Friday. Banking stocks really led that charge. Metal stocks also were shining in trade. All in all, it was a good week for the markets. Both the Sensex and the Nifty were up nearly 3%. Joining us today to help us strategize our portfolios is Paras Edelweiss, the Managing Director and Principal Portfolio Manager at Capital Portfolio Advisors. Paras, it's always such a pleasure to have you on the show. And what I want to do this week is start with Paras's portfolio to give you an idea of what we've been doing over the last 1 year. Now, this portfolio is almost a year old. It'll be a year old next week, in fact. And it's given us an overall profit of 18.66% to be precise. The portfolio was designed on the 7th of December last year. Now, compare that to the Nifty. The Nifty is up about 4.5% over that same period. So, Paras, the portfolio has done really well. I'm going to give our viewers a recap of the stocks you picked for us, and then we'll come back and we'll talk about how this portfolio has performed. There's Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, ING Vaishya Bank, Tata Steel, Bajaj Finance, PVR, and Shobha Developers. That's 10 stocks all in all. Paras, I remember when we designed this portfolio, you talked about how you picked 10 stocks because you wanted a portfolio that was diversified but still easy to manage. Now, is that the string of thought that still causes this portfolio to be our top performing portfolio on this show?
Yeah, I think the thought process continues to remain the same, and I think we need to be consistent in our thought process to be able to kind of deliver good performance. So the rules of investing remain the same, and the thought process also remains the same.
All right, let's talk about some specific stocks in your portfolio. PVR is up about 100% in the last 1 year since we bought it. Sun Pharma is up 63%. Thank you for the strong recommendations. And do you think it's time to book profits on these stocks, or can we hold on to it and hope for more?
While the valuations are not as cheap as they were about a year back, but do I really need to book profits in them? The answer is no, because I think the growth trajectory will continue to be very strong for these guys, and therefore, despite the seemingly expensive valuations with a 1 year perspective, I would not really like to book profit since the portfolio is at least for 3 years or 3 to 5 years.
All right, so we're not booking profits. The other stock I'd like to talk about is Shobha Developers. I remember when you picked this stock last year, you talked about the fact that you expected the real estate industry to begin a recovery of some sort. You said the valuations were very good. We're now hearing some news of perhaps FDI being allowed in this industry. What are your hopes for Shobha Developers going forward? It's down about 11% since we invested in it. But going forward, what are your expectations from this stock?
I would continue to hold on to this stock, considering the fact that more than 60% of its sales comes from the Bangalore market, and the balance comes from Gurgaon and Pune. I think while the real estate market has not performed in line with what I really perceived, but considering the pockets that Shobha Developers operates in, and also considering the fact that they have a slightly different business model as compared to other real estate companies, I think the current valuations are very cheap for the stock. After looking at their business model, after looking at the quality of management, and of course the quality of balance sheet. So there is absolutely no reason for exiting the stock.
I also have a question for you about Axis Bank. Now, when we started this portfolio, you picked three banks. You had SBI, Axis Bank and ING Vysya. SBI, which you exited. Axis Bank is down about 13.5% since we bought it. Now, what are your expectations from Axis Bank as well going forward? You are obviously holding on to the stock, but tell all of our viewers who are holding Axis Bank what to expect from this stock.
This again is a very high quality bank. It has had some amount of impact due to a slowdown in the economy because of a higher exposure to the industrial segment as compared to someone like an ICICI bank or an HDFC bank. So some of those lumpy loans did affect the bank in the very short term. But I think some measures have been taken by the bank, and the growth trajectory, in my view, can only improve from the current levels as the economy takes a U-turn. So the valuations are at a discount to HDFC Bank and also to ICICI Bank. My sense is over a period of time, the gap between HDFC Bank and Axis Bank in valuations will kind of reduce. And to that extent, the outperformance of Axis Bank over HDFC Bank or even the banking sector will be higher, as we move along. So I think the prospects continue to be very strong, and there is absolutely no reason to exit out of the stock.
Well, Paras, if anybody is watching right now who hasn't invested in this portfolio so far, is it too late now? Can they still start investing today?
Oh, absolutely. I think since the portfolio is a 3 to 5 year portfolio, there is considerable amount of room for appreciation over the next 3 years. So one can really buy into the stocks even today.
I'm going to ask you to do this one more time, and over the last 1 year we've asked you to go over your portfolio fundamentals several times on this show, but give us again the rules of putting a portfolio together in the background of the fact that you have such a successful portfolio on this show. Tell us one more time, as retail investors, if we're investing for a long-term horizon of 4 to 5 years, what are the rules we should keep in mind?
I think the rules are very simple, and they have proved time and again right. For years along. The number one rule is look out for the long term rather than look out for short term. Two is look out for the quality of management and their stake in the company. Three is look out for the sustainability of the business and the visibility of the business. And four is look out for the quality of balance sheet. Is the balance sheet over leveraged? And of course, finally, and also very important, is the valuations. If all these 5 rules are followed regularly, there is no reason to believe that over the longer term one cannot really make money.
Alright, so Paras's rules are on your screen right now. Remember, Paras's portfolio has been the most successful portfolio on this show, and every time he comes back on the show every few weeks, we take a look at how his portfolio is doing. We ask all of our guests, of course, to give us a close account of how their recommendations are doing on this show. What I'm going to do is give you a recap of the stocks that Paras has picked out for us, so you can write them down. Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, ING Vysya Bank, Tata Steel, Bajaj Finance, PVR and Shobha Developers. If you have any questions at all for Paras about this portfolio or about your own portfolio, write to us. Our email ID is at the bottom of your screen. It's time for a very quick break, but stay tuned. When we come back, Paras is going to pick out 2 stocks for you to invest in right now, and we'll also take a very close look at the tire sector, find out what's going on there. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. Paras Edenwala is still with us, helping us figure out our long-term strategy when investing in stocks. Now, we've also asked Paras to bring in 2 stock recommendations for this week. Stocks that can be invested in right now at their current valuation with a long term of 4 or 5 years as a time horizon in mind. Paras, what stocks would you like us to pick up this week?
There are 2 stocks that I would like to recommend today. The first one is JB Chemicals and the second is Dhanuka Agritech. And just a disclaimer that we have investments in the stocks. JB Chemicals is a very old company in India, and has been very well managed for the last more than 4 decades. The company has some of the most established brands in the country, like Rentec, like Metrogile, and have been traditionally very strong in conventional, therapeutic segments. But now it looks like, with some young blood coming into the management, there is some change happening in the business mix of the company. You will see more of exports happening. You will see some more chronic illnesses being catered to, and you will also see contract manufacturing happening. And all this is likely to benefit the growth rates of the company. Traditionally, the company has grown at anything around 10%. You will see these growth rates getting augmented to anything around 15% to 20% as we move along, with better growth in profitability. As we see today, the composition of the business is about 52% comes from exports, about 35% from domestic formulations, and the balance comes from contract manufacturing. And we would certainly be happy to see the contribution from exports increasing, and therefore any depreciation in the rupee will benefit the company. I also expect the company to see an upward trajectory in the operating margins. The company has cash after it sold off its OTC business in Russia, which is to the tune of about 500 crores, which is almost 50% of the current market cap. And the valuations are very cheap at just about 7.5 times on FY15 estimates, which is at a steep 60 to 70% discount to the average pharmaceutical discounting. So my sense is the stock should give very good returns, at least a 50% return over the next 1 year. The second one that I'm picking is Dhanuka Agritech. Dhanuka Agritech again is an old player in the agrochemical space, but has again a differentiated business model. They are the only player to be only into formulations as compared to other guys who are also into technicals besides formulations, and they prefer integrated approach rather than a focused approach. But Dhanuka is very clear. They would like to have an asset-light model, and therefore they're focusing only on formulations. And they also have tied up with large multinationals like Mitsui, Sumitomo to get their molecules into India and market them into India. More than half of the turnover comes from such tied up molecules, and therefore are technically very sound. With better monsoon, I think the sales in the current year should be very strong, and this has been very evident from the first half numbers, where the company has done brilliantly, outperformed the industry. I expect the company to keep on growing at about 20% at least for the next 3 to 4 years, if not better, and with the margins kind of being on an upward trajectory. They have an ROI of about 30% plus, which is also among the highest in the agrochemical space, and it's a completely debt-free company. So this high growth company with a very clean and focused management is available at just about 7 times on FY15, and here again I would expect a 50% appreciation over the next 1 year.
All right, 2 recommendations there from Paras: Dhanuka Agritech, which is on your screen right now, and JB Chemicals. Remember, every time he comes back into the studio, we'll take a look at how those recommendations are doing. It's time for us to answer a couple of questions. We have a question from Pavan that's come in. He has 500 shares of JK Tyres, which he bought at 113 rupees. He wants to know if he should hold that stock. The stock ended the week at 158, so he's making a profit. It hit a 52-week high on Friday. In fact, most tyre stocks have been rallying recently. Let me bring in my colleague Ajay to give us an update on what's happening within the tyre space. Ajay.
Well, Faye, this week mid caps overall performed more or less in line with how the large caps perform. But one pocket of the mid cap, which was the tyre sector, the auto ancillary sector, really stood out and is witnessing a lot of value buying. A couple of fundamental factors also leading to buying in the tyre stocks. In fact, some of them among C8, JK Tyres and Apollo Tyres also making fresh lifetime highs. The big factor which is working in favor of tyre stocks is the fall in natural rubber prices. In fact, natural rubber prices are hovering now at 4-year lows. Even the crude oil prices coming down is making a case that synthetic rubber will also fall, and hence on expectations that raw material prices will be much lower for tyre companies in next few quarters. A lot of value buying is happening. In fact, even in the second quarter, the quarter gone by, we saw good results from several of these tyre stocks. So most of the fundamental analysts believe that there is still case to be made as far as buying in tyre stocks are concerned. However, the sharp run up we've already seen in some of the stocks, now investors should look at declines to enter in these stocks.
All right, Ajay, thank you for that information. Paras, as far as JK Tyres is concerned, he is making a profit on that stock bought at 113. What's your recommendation? Should he hold on to it?
Yes, certainly. I think he should hold on to it because the rubber prices are falling. The demand recovery should happen gradually, and the stock is very cheap, and therefore there is absolutely no reason to exit out of the stock.
In fact, while we're talking about tire stocks, we also have a question from Venkat Ramanan, who's written in. He has 100 shares of Apollo Tires, which he bought at 96 rupees. He wants to know if he should hold on to that stock. He's not making a profit on that stock, but does it make sense to hold on to Apollo Tires as well?
Oh yeah, I think Apollo has underperformed the rest of the tire stocks largely because of the Cooper deal, which itself is in jeopardy. And if the deal is called off, I think one will see quick appreciation in Apollo Tires. The fundamentals continue to be strong, and the stock is grossly undervalued as compared to rest of the peers. So I think it makes a lot of sense to hold on.
All right, hold on to both of those tire stocks. In fact, we have time to take a look at one portfolio. Vipin has written in. He sent us his entire list of stocks and he'd like us to tell him which of these to hold on to and which of these to sell. Top of his list, 400 shares of Escorts, which he bought at 63 rupees. Escort ended the week at 117, making new, annual highs in November. What's your call on Escorts?
I think the company is absolutely on a roll post restructuring. And good monsoons can only augment the growth rates of Escorts, while the immediate valuations may seem a little stretched. But if the investment horizon is long term, I think it makes a lot of sense to hold on.
He also has 50 shares of Jindal Steel, which he bought at 328. What's your call on Jindal Steel?
Jindal Steel also is looking very interesting at the current levels, with the steel cycle expected to improve, and Jindal Steel being into value-added products of steel, coupled with power generation and power trading. I think the mix is much more richer, and therefore the company should do well as the cycle turns. The valuations are cheap, and therefore anyone willing to hold on for a couple of years, my sense is the stock should give above average returns.
He has 100 shares of HDFC, which he bought at an average price of 910 rupees. That stock ended the week at about 823. What should he do with that stock?
Yeah, I think HDFC is again a very high quality stock, but is an expensive stock. I think the company will give returns, in line with the market, and I would recommend holding on to it.
All right, we're going to take a quick break here. Paris is going to stay with us. When we come back, we'll talk about stocks like Vocard and Ambuja Cements. Don't go anywhere. Back, you're watching All About Stocks on ET Now. Thank you for staying with us. Paras Edenwala is still with us as well, helping us make money in the long term. Well, Yudhvir has written in. He has 50 shares of Vocard, which he bought at 483 rupees. He wants to know if he should hold on to that stock. Paras, there have been some concerns over the recent warning the company received from the US FDA. What's your call on Vocard?
It depends on the kind of investor he is. If he's willing to take the risk for some more time, I think Vocard really could turn out to be a multi-bagger. I think in the very immediate to short term, a company will keep on facing these headwinds, and as they keep on addressing the issues of the US FDA, I think the multiples of the stock will keep on improving gradually. As far as the next 6 months is concerned, my sense is the stock may not do very well and make a kind of underperform the rest of the market. But over the next 1 to 1.5 years, I think it could be really an outlier and could also turn out to be a multi-bagger. I would recommend holding on to the stock.
I'm told we can take a look at one last portfolio before we wrap up this show. Well, Meethu is our lucky viewer. We're going to take a look at your entire portfolio, Meethu. Top of her list, Paras, Ambuja Cements bought at 140 rupees. Should she hold on to that stock?
It's an expensive stock. The cement cycle is down, but the company has very high quality of assets. On an upturn, hopefully this company should really benefit. So if the investment horizon is about 3 years, hold on to the stock.
She also has 100 shares of Coal India bought at 490 rupees. Now, Coal India is one of those stocks. It's a monopoly. As a company, it should be doing far better than it's doing right now. When do you expect Coal India to recover, if at all?
Very hard to say, as to when the company, the stock will recover, because the fortunes of the company are, they depend on the policies of the government, and therefore are not market driven. So I honestly don't expect Coal India to really do well in the future. I would seriously urge the investor to take the losses and exit and reinvest the process into something better.
She also has Infosys, which she bought at 29.72. So she's making a profit there. And we heard Narayan Murthy talk to the press earlier this week. He talked about how he's positive about the changes. He expects the cost cutting to pay off fairly soon. So are you also positive about Infosys? Does it make sense to hold on?
Oh, absolutely. Infosys looks very good at the current levels. Just one quarter of good numbers and you will see the re-rating happening. I think it is perhaps one of the best picks in the market today.
22 shares of Jayaprakash Associates bought at 70 rupees. That stock was down to 53 rupees this week. Does it make sense to hold on?
Yes, I think with infrastructural activity likely to pick up after the elections, hopefully, I think this is one stock which will really benefit. It has exposure to engineering and contracting. It also has exposure to cement. So both the sectors and segments should do well post-elections. I think the valuations are cheap, and as the company keeps on deleveraging, the valuations of the company will keep on improving. Makes a lot of sense to hold on.
All right, finally 10 shares of RIL bought at 1,050 rupees. RIL ended the week at about 850. What should he do with that stock? Hold on to it?
Yeah, it's a granddaddy of the Indian capital markets. It will give returns in line with the market. And if anyone is willing to is happy with that kind of return, I think one should hold on.
All right, we end with the granddaddy of the Indian capital markets. Unfortunately, we've run out of time. Paras, thank you so much for spending time with us this week and giving us those extremely strong recommendations. We look forward to having you back again on this show very soon. If you have questions for Paras, send them to us on the email ID at the bottom of your screen. You'll also find a copy of this show on our Facebook page, and you can reach me personally on Twitter. Thanks for watching.